Well, good morning. And welcome to the family estate meeting. Prop 19 changes everything. We have a lot of people on today, and I'm going to be here as long as it takes. There will be a Q&A. We'll do that at the end. And also there's a Q&A button on your bar if you're watching this live. If you're watching this recorded, obviously it's not going to work. But my name is Jim Cunningham. I am the president of Cunningham Legal, and this is our super post-Thanksgiving family meeting where we recommend that all the family members come in with their parents, watch this thing, and we're super excited. And we're going to cover a lot of ground, so let's get started. The first thing right out of the gate is disclaimer. I'm a lawyer. My lips are moving, and this is not legal advice, okay? Legal advice is one-on-one with a lawyer, and we're going to give you the opportunity to meet with one of the attorneys here at Cunningham Legal. Go to our website, log in, and we're doing 1-hour appointments to go over Prop 19 specifically. And I do recommend that if you own property in California, that you do make an appointment and you do visit with us on that, because this is, as you'll see, very, very important. These are the lawyers in our law firm. That's me on the left. We have Tasha John, Connor Clemens, Rochelle Lee Warner, Liz Seitz, Jeff Rosen, and Janice Lee Shen. Each of these lawyers practices strictly in the trust and estate area. We are very strong in the property tax arena, and we've been helping a lot of clients navigate Prop 13. So this is the family estate meeting. I recommend that many of you, frankly, most of you, with some exceptions, right, meet with your family and go over your estate plan. It's very important that they understand it, because important decisions about important personal and financial matters are often made and not communicated to your loved ones. And on top of that, Prop 19 changes everything. We recently had a client come in who did not realize that the parents had changed their estate plan, had done what's called a restatement, where you take out the old living trust and you put in a new living trust. And that was a real different estate plan from a tax planning standpoint. And unfortunately, they waited a couple of years and lost out on a lot of good tax benefits. So it's very important that you, if you are the person, certainly if you're the person designated by your parents, for example, to handle their stuff when they get sick or pass away, then you definitely want to be in communication with your parents and know what the estate plan says. So today we're going to cover Proposition 19. We're going to also cover caring for a loved one who's alive but needs help, right? So maybe somebody who is declining mentally or declining physically, or has some type of mental, or Parkinson's, Alzheimer's, stroke, dementia, whatever it may be. And then we'll wrap it up with handling the affairs of a loved one after death. Just some real important points. We're going to cover some things that can really be gotchas if you don't pay attention to them. So let's get to Prop 19. Prop 19, what just happened? First of all, Proposition 15 did not pass. And by the way, we are talking about Proposition 19 having to do with real estate transfers, not Prop 19 from a few years ago that legalized cannabis. So if you Google Prop 19, you're going to see both of these come up. So if you're watching this expecting me to talk about the legalization of cannabis, you're at the wrong webinar. Okay, so you can leave now. Prop 19 did pass. Okay. Prop 15, it was kind of a head fake in a way. It was everyone was talking about Prop 19. Prop 19 would have reassessed commercial and industrial properties to fair market value and basically eliminated Prop 13 for the property owner. What we're talking about here is not so much a negative when it comes to Prop 13 for the property owner, because it's really a net positive in many ways that we'll cover. What this does do is this eliminates Prop 58, which was the ability for the parent to pass the property tax benefit to the children within limitation, but it is or was until Prop 19 passed, and until February 15th, a parent can transfer a home of any value to the child, and the Prop 13 tax base carries over. That rule goes away, and then each parent can leave $1 million in assessed value to their children. That entirely goes away with Prop 19. So almost 17 million votes have been counted. They actually have not counted all the votes in California. I believe they have 2% more to go. But you can see it passed by a very narrow margin. So understanding Prop 19 requires an understanding of Prop 13, which was passed in 1978. and an understanding of Prop 58. So there are a lot of lawyers on this webinar. If you practice in the trust and estate arena, you know that these are very important propositions. If you're not a lawyer or you don't really practice in this area, you're a consumer, you might not know the meaning of these, but it's important to understand these because the law is changing. So Prop 13 is passed in 1978. That's actually me as a kid in Ventura. My parents bought a condo in Ventura for $30,000 and moved out a year later. They actually moved to another condo. They kept hopping and buying properties. The property is now worth $435,000. The property is assessed at $71,000. Now, you might look at that and think, why isn't the property assessed at $435,000, right? If you're in another state, it's common for property to be assessed at its current fair market value. That is not the case in California. California has this weird cryptic system. When you buy a property, when there's a change in ownership, the property is assessed at its market value, right? Not what it sells for, its market value, which is typically what it sells for in a arm's length transaction. But then it only goes up a maximum of 2% a year, and that 2% is tied to the California Consumer Price Index. It has nothing to do with the price of real estate. It's just essentially a cost of living adjustment that goes up over time. So my parents' property taxes are $834. So Prop 58 lets this little kind of pudgy kid here keep his parents' Prop 13 exemption and my kids until Prop 19 passed. So I inherit the property from my parents. I can pass that on to my kids, and so on and so on and so on. Sweet, right? That's a really good property right to have. So what if mom and dad sell the condo to somebody else? This is this crazy Prop 13 system. They sell the property to somebody else, to this lovely couple here. They buy the same condo. Nothing's changed. They buy the same condo, stay there for years. Their property's worth $435,000. That's a typo. Taxes are $5,000 a year. So $834,000 when the property changes hands, they go up to $5,000 a year. This is very important because the parent-to-child reassessment exclusion goes away February 16th. So when your kids inherit your property, they no longer inherit the Prop 13 tax base effective February 16. Now, the current property tax structure, as I mentioned, the property is assessed at 1% of its market value when there is a change in ownership. A change in ownership includes death. A lot of people don't think of death as a change in ownership, but the old saying, you can't take it with you, that's actually true. You can't. And when you leave this earth, the state of California says that is a change in ownership, right? A sale obviously is a change in ownership. A gift, also a change in ownership. Gifting, we're going to talk about in our planning section. Sometimes you can make a completed gift for property tax purposes, but what is considered to be an incomplete gift for estate tax purposes, and that is highly relevant to capital gains taxes. And I mentioned there's a 2% increase, even though real estate historically increases at 4% or more per year. So the closer you are to water in California, what happens? Prices go up. They go up way faster than inflation, right? They go up and up and up. So long-term owners of California real estate have a very low property tax burden when compared to new owners, right? People who recently acquired. And I'm spending a little bit of time on here because this is a very fundamental concept to understand as we go through the materials. And the difference is, $4,000. That's a lot of money. Sometimes the difference is a lot more. We met with one client who has $10 million in property with a $1 million assessed value. That client can transfer that property to the children. And when that parent dies, the taxes won't go up $90,000 a year. That's a huge savings for the family. It's a huge real property benefit. I look at this as a property right, a property benefit, Prop 13, and you really need to pay attention to it. So change in ownership, the parents, as I mentioned, can leave a primary home of any value. Each parent can leave $1 million each in assessed value to the children, right? Collectively. So it's $1 million per person that you can leave in assessed value. So if the parents have a $2 million property with an assessed value of $1 million and a $10 million property with an assessed value of $1 million, if it's done right, those $12 million in properties can be transferred to the kids, and the kids take that low property tax base. So Proposition 19 is effective February 16th. It passed 51 to 49. It repeals Prop 58. This is what you need to know, okay? Oh my goodness, it repeals Prop 58. It's gone. This is a really, really big deal. So there is some good stuff. So I don't want to freak everyone out. There is some really good stuff. And here's the good stuff. Prop 19 allows you, if you're 55 or over, or if you're over 55, and I was speaking with the person at the Board of Equalization this week, and the legislature will be meeting in January in California, and they're going to define that for us. So what they've done is they've kind of drawn the lines, if you will. Prop 19 has drawn out the lines, and the legislature kind of colors in the boxes. And that's really important to understand, because as we go through this, we don't know what the legislature is going to do on a lot of this stuff. So your Prop 19 allows you to take your Prop 13 taxes with you to buy a new home 3 times in your life. Now, is this per person? Is it per property? Look, we don't know. It might be per person. So if you're a couple, theoretically, you could do it 6 times, because transfers between spouses are not considered a change in ownership. Even if the property is a more expensive property. So right now, within the county, if you stay in the county and you sell your $1 million home with a $100,000 tax base, you can buy another home for $1 million and transfer your tax base. If you're 55 or over, you can only do it once. There are a few counties in California that let you move. They're generally in Southern California and Placer County in Northern California. But now this Prop 19 allows you to move anywhere in the state. So you could sell your beachfront San Diego property for $5 million with $1 million assessed value, and you could buy a $6 million property in Malibu. I don't know if that'll get you beachfront, and your property taxes would only go up on the difference, and we'll cover that in a little bit more in detail. So super important, and there's a sweetener in there for people who are victims of wildfires and disabled. So let me give you an example. Husband and wife buy a home in Pasadena in 1980 for $200,000. Today it's worth $1.2 million. The property taxes have gone up no more than 2% a year. Now they pay $5,000 a year. The husband and wife, they sell the Pasadena home and they move to Roseville, which is in Placer County in Northern California, to be closer to their daughter for $700,000. They take their property tax base with them. Now, right now, you can only do that once, but going forward after April 1st, so it's a different date, different effective date, you'll be able to do that 3 times in your life. Upgrading, Prop 19. Here, this is a really cool feature of Prop 19 that is not current law. So this will happen in the future, not today. So don't run out. Again, that's why that disclaimer is important. If you're watching this and it's not April 1st of 2021, this is not the law yet, okay? So let's say they have the $2 million home. It's worth $1.2 million. They sell their Pasadena home. They move to Carlsbad and they buy this beautiful home for $3.2 million. The first $1.2 million of that Carlsbad property, not reassessed. They keep their $5,000 a year tax bill. The next $2 million is taxed, and it's taxed at the current rates, which is about $25,000 a year. So their annual tax is $30,000 with Prop 19, and it would have been $40,000 without Prop 19 if they had sold their Pasadena home and they bought that home in Carlsbad, $10,000 more. Now, for some people, this is a big difference. This is meaningful. This keeps people from moving. For other people, typically are very wealthy clients, they really don't care, right? Because, they just don't care as much. Gaming the system. So I'm calling this gaming the system, and this is a negative connotation. But this is just some creative thinking on my part. What can we do after April 1, 2021? So gaming the system, number 1. The married couple has a home and a rental. Okay, so their husband and wife are living in the home and they have a rental. The husband kicks the tenant out and makes his rental his primary residence. And the husband and wife sell the home, which is the wife's primary residence. And then they together buy a new home so they can combine the tax base of the rental and their primary residence and put those together and mash up the 2 Prop 13 exemptions. This is why I call it gaming the system. I think you can see it's kind of a creative way of looking at it, but this is going to be a really interesting area of the law going forward for attorneys, where clients and realtors and financial advisors and attorneys will all be working together. But again, this is I call it gaming the system because this is just a little creative thinking. I don't know if this is going to actually, be legit or not. I don't know. So let's look at this example. The home has $1 million value and $100,000 tax base. The rental has $100,000 value and $1 million value and $100,000 tax base. These are just examples, and you may think, oh, this is a crazy example, but it just makes the math a little bit easier so you understand the concept. What they do is they take those two properties, they convert the rental to a primary residence, okay? They take those two properties and then they combine them. So they have a $200,000 tax base on a $2 million property. Forget capital gains taxes, forget all that other stuff. But this is an example where, it's an example of gaming the system. So gaming the system too. The parent converts a rental to a residence. The parent transfers the erstwhile rental, right? It was a rental, now it's a residence, to the child. The child takes the parent's tax base. The child after age 55 can then take that tax base to a new home, right? Because a parent-to-child transfer, the exemption is $1 million. Is you take the property with the tax base, and we have an example a little bit later, and you can inherit or have transferred to you an additional $1 million in value without being reassessed. So this is another example. So the rental is $1 million value with a $100,000 tax base. The parent evicts the tenant, claims homeowner's exemption. The parent transfers by gift or sale the property to the child. The child claims the homeowner's exemption, and the child can take the tax base to another home after age 55. This is presently theoretical only. It's just me with some creative thinking. I don't know that this will actually be legit in the future. So who was behind Prop 19? Who do you think? Realtors. Well, here's what's going to happen. Next year, 2021, you're going to see a lot of properties trading because people can now take their Prop 13 tax base anywhere in the state. So the bad stuff about Prop 19, as we mentioned, the parent to child, there's also a parent to grandchild transfer. We don't see that a whole lot. It's because the parents of the grandchild both have to be deceased, and that parent could not have taken a parent to child transfer. So we don't see that often. It is there though. So the parent to child transfer of a home by gift or inheritance. Here's the deal. The bad stuff about Prop 19, if it is a parent to child transfer, the only way that you're going to avoid reassessment is if the parent claims the homeowner's exemption. Now, do you have to live there? I think it's probably a good idea to live there. I don't see that the parent actually has to live there. They have to claim that as their homeowners, on their homeowner's exemption, that $7,000 deduction from your tax base. That the parent has to check. The property is then transferred to the child. The child has to check the homeowner's exemption within a year. So again, are people having to move into these properties? Probably a good idea. That's sort of the spirit of the law. I'm not suggesting that you ignore that portion. We just don't know. And again, the legislature might come out with a rule that says you have to live there for a year or 5 years or the rest of your life. We just don't know. So you got to occupy the property. You get the tax base plus $1 million in value. And we're going to cover what that means and how that $1 million is calculated. But this law is effective February 16th. Here's the problem. February 15th is President's Day, and February 12th is I believe it's Lincoln's birthday or Washington's birthday. Anyway, the recorder's office is closed the Friday and then the following Monday before the date of Tuesday when the law is effective. So the real deadline is Thursday, February 11th. And I will tell you that the recorder's offices are taking a very long time to record deeds. We're seeing it a month, 2 months, even 3 months in some counties. So if you're thinking, hey, I need to take a look at this, I need to think about, do I want to transfer these properties to my kids now to protect the Prop 13 tax base? You need to start that decision-making process immediately, frankly. We are quickly running out of bandwidth in our firm because there's so much interest in this from our clients, and other lawyers are reaching out to our firm. So, we're here to help our clients, but you really do need to get on this. Don't wait on it. So Prop 19 guts Prop 13 for rentals, right? It takes away Prop 58, which takes away the parent-to-child transfer, means your residential, commercial, industrial, everything's reassessed at your death. and your vacation home. Now we're seeing, as we're meeting with clients, a lot of interest in preserving the vacation home. You know, a lot of people have a mountain property, or they have a beach property that they may have bought a long time ago or may have inherited. And that family, there's no way that family could certainly afford to buy it today. Or if the property were reassessed, the family could not afford to keep it. So it is not uncommon to have a, you know, $3, $4, $5 million property with an assessed value of 500,000 or 400,000 or 300,000. So the taxes are, you know, $5,000, $6,000, $7,000 a year instead of 50,000. Okay, so that's the difference. So how do Proposition 13 taxes work now when a parent dies and leaves property to a child, at least until February 15th? This is how Prop 13 works. Until February 15 of 2021, this is a home. It's actually a home I took off the internet that's for sale in Los Angeles, and it's listed for $1.7 million. So the parents buy the home in the 1970s for $100,000. It's now worth $1.7 million. The assessed value is now $200,000. The child inherits the property. The child does not have to live in the property. Child inherits it, turns around and rents it. This could even have been a rental property, right? And so this property passes to the children. The taxes stay at $2,500. Most importantly, the taxes only go up 2% a year, so they only go up $50 a year. After February 15 of 2021, the same home, assessed value is $200,000. If this property is the parent's primary residence, and if the child moves into the home, at least that's what we're thinking they have to be, you have to claim that homeowner's exemption. The child inherits the assessed value plus $1 million. So 1.2 million is not reassessed. Everything above that is reassessed. And so the child's assessed value is 200,000, and then you get an extra $1 million for free. And then that next 500,000 is reassessed. And so the property taxes go from $2,500 a year to $8,700 a year, and then increase at $175 thereafter. So lots of change on this parent to child with Prop 19. So if this is a situation that you think you might be in and you're like, well, that kind of stinks to have them go up that much, then, you know, reach out to us, go to our website, CunninghamLegal.com, schedule an appointment, and we'll go over how that works in a few slides. So after Prop 19, the $1 million exclusion that I mentioned is beginning February 16, 2023, adjusted according to the House Price Index for California by the Federal Housing Finance Agency. Basically, that $1 million, the $200,000 assessed value is pegged according to the California Consumer Price Index and only goes up 2%, maximum 2% a year. The $1 million exemption is pegged at the House Price Index for the whole of California. And this is a published index. And from 1995 to 2020, it increased 339%. In a 25-year period, it increased 339%. Now, if you think about this for a while, if your $200,000 tax base is not going to keep up with the cost of housing, and you have this $1 million this $1 million exemption that does keep up with the cost of housing, the price of housing, at least statewide. And as you know, there are certain areas that go up faster than the average in the state, right? They just do. Those, if you project the math going forward, there are situations where that $1 million exemption will never be big enough to fully avoid at least a partial reassessment. So this requires a fair amount of forecasting, financial planning. This is something that when we sit down and meet with clients, that we go over with them. But you need to understand, we're having two different indices, one index that's tied to the California Consumer Price Index, and the other is tied to the House Price Index for California. If this is just all like a foreign language to you, welcome to the club. I've been talking to a lot of lawyers, and we kind of feel like our brains have to get rewired a little bit to understand this stuff. I've been living with this for a few weeks now, going over it, and been in a lot of different study groups with internally in our firm and also across the state. And everyone, I will tell you, just full disclosure, everyone's having a really hard time just grasping this as lawyers. So this is going to be part of it too, is we don't have all the rules. So now let's fast forward to 2045. It's 2020. Let's get in the time machine. This property, The assessed value is going to go from $200,000 to $320,000. That's increasing 2% a year. The $1 million exclusion goes to $3.2 million. The value of the home is $5.8 million in 2045. The parent-to-child reassessment exclusion is $320,000, which is your Prop 13 tax base, plus your Prop 19 exemption of $3.2 million. That brings us to $3.5 million. Okay, roughly. So 5.8 million minus 3.5 million is 2.3 million. So your taxes go from $4,000 a year to $32,750 a year. And you have to live in the house. You have to claim it as your homeowner's exemption. Your parents can't have rented this out. So going forward as practitioners, these are the sort of calculations that we'll be doing with our clients. Is it possible to double up on the parent-to-child exemption? I don't know. You know, the rules aren't in, but this doubling up may require us as estate planning attorneys, and it may require you as the client and the family members of the client to change your estate plan in a way that preserves a deceased spouse's $1 million exemption, right? So I think there's a way to do it. I'm not sure. We're going to make sure that, you know, one thing is, we take a very conservative approach when it comes to estate planning. We're only going to recommend stuff that we know is going to work. We're not going to recommend stuff. It's like, well, it might work. I don't know. You know, your taxes might go up. There's no way. We're not doing that. Okay. So, so action items, seek advice now. If you own property in California and, you want that property to go to your kids and you want to keep the property taxes low. Okay. Seek out advice, reach out to our firm. You can go to CunninghamLegal.com, set up an appointment. You may need a possible rewrite to your estate plan to preserve the double parent-to-child exemption for the home. Maybe, maybe not. We don't know. We don't know what that plan would look like. These meetings, by the way, they last an hour, and we need your property tax bills, your estate plan, and your a completed client questionnaire where we ask a lot about your family and assets. And then we're charging $500 for that 1 hour. And so we've had a lot of people reach out to us. We're doing a lot of these meetings. We have a lot of lawyers reaching out and paying the $500 to go over it for their own situation. So the bottom line is you need to find an expert advisor. You need to seek advice and follow it. And if you're a lawyer thinking like, man, this sounds really complicated, but it's only short term, I really don't have to learn this stuff. I kind of think you have to learn it. Because this exemption planning for the home, at least, is going to be much more complicated now with Prop 19 when you have a married couple. What about multifamily, commercial, and industrial properties? What I'm going to do, we had a lot of chat questions here. I'm going to see if we can answer some of these here. Recorded deed can you do a recorded deed with an unrecorded occupancy agreement to get the step up? Yeah, I think you can, but you have loss of control. We'll cover that. Are the material slide deck available to download? Yeah, Eden Rose, you can just reach out to me. What if the property is held in a revocable trust? The assessor's office looks through trusts. They disregard trusts for determining property tax issues. So they disregard all trusts. They don't disregard all trusts in the sense of they ignore the terms. They disregard it in the sense that it's in a trust, and they look at who the people are who are inheriting in the trust. Can we add a child as a co-trustee now and then the child retains long-term in trust at current property tax base? I don't think that's going to be. A co-trustee is legal title. It's bare legal title. It's not equitable title. I don't think that's going to work. Wendy asked, do you know about a 2-on-1 property? I own a house with a rental condo on the same lot. Even if my son lives in the primary condo, he would rent out the condo. I don't know on that one. It might come down to how many parcels there are. And this is how the assessor's office looks at it. Well, is it 2 separate tax parcels or 1? And so if you're renting out, and another question came up this week, what about an ADU, an accessory dwelling unit? We just don't know. The legislature is meeting in January, and hopefully they'll pass some laws that will help us. Any advice for farms? Williamson Act effect? I don't know. And again, I think this is going to be a legislative implementation. I haven't seen anything yet. What if the parent gifts a primary residence to several children, but only one of them intends to reside there? Well, Jonathan, that's a great question. then I think there's a partial reassessment, because the child, you're not looking at the property per se, you're looking at the owners of the property. So the parents have to check the claim for the homeowner's exemption, and then the child, when they inherit it, they have to claim the homeowner's exemption with a year. Now, if you had 10 kids, could they all claim the homeowner's exemption on one house and never set foot in there? I don't know. And if you're watching this from the Board of Equalization, it would be nice if you could give us some guidance, right? How long do you have to be there? Our legal system is really different than the Napoleonic legal system in Europe. It's just their rules are very well defined, right? Not so much in our Anglo-American system. What about parent and child as joint tenants on the primary home, or parents and children as tenants in common? That there's a lot going on in that question. Emily, I would need to know a lot more about that, because if they're the original owner or not, there's a lot of stuff going on that one. What if the death occurred in 2018 and the successor tree wants to leave the house in trust indefinitely, the house being rented? Sandra, it depends on how the terms of the trust are written. It depends on the powers of appointment that are in that continuing trust. So this is something for the lawyers. If you have a general power of appointment in a trust, when the person dies holding the general power of appointment, that is deemed a change in ownership from the holder of the general power of appointment. If it's a limited power of appointment, it's deemed as coming from, if you exercise it, it's deemed as coming from the person who owned the property that you inherited the property from. So again, there's a lot more depth to this. There's a lot more, as you peel this onion back. There's no easy answer to a lot of these questions. Do you think there might be an exception for special needs parent to child transfers for children that cannot work due to disabilities? Yes, and that's one of them. That's a really good question. It is possible. I think, part of the larger planning question, especially with the special needs child, is what is the world going to look like for that loved one with special needs after you're gone? Will that person continue to work in the house or live in the house? I think it depends on the situation. Valerie asked, what if the property is held in the trust? As we said, the Board of Equalization looks through the trust. Let's see. I purchased a property about a year ago with parents as tenants in common on the title. Should we quit claim parents off title before 2/16? If you purchase, Ashley, if you purchase the property with your parents as tenants in common, first of all, I'm not giving you legal advice, but I'm answering your question. Original owners, when an original owner dies and the property goes to the original owner, typically like in a joint tenancy situation, then there is no reassessment, okay? Because when property ends up with an original owner, there's no reassessment, but it depends, okay? So this is why, Ashley, I would highly encourage you to make an appointment and pay us some money and go through your example to say, in your case, given these facts, the property will or will not be reassessed, because it might be reassessed, okay? So I just can't give you an answer. Can that family house be transferred into an LLC? And that's anonymous. Anonymous, the problem with putting a home in an LLC is an LLC is a business entity and a home is a home. A home is not a business. And so you have that issue. Also, when you transfer it into an LLC, the Board of Equalization does pay attention to entities, okay? They ignore trusts for the purposes of property taxation. They really pay attention to entities, and that it could be problematic. It might be a good thing. Okay, so multifamily and commercial. We'll come back to these questions in a little bit. Same house. Boy, we keep looking at this house in West LA. Assessed value $200,000. The parents move out. They move into assisted living and they rent that house out for gobs of money, right? It's in a great location in LA. So the parents move out and the house is rented. That means that they don't live there anymore. That's not the parents' residence. When the child inherits the property, it's reassessed entirely. The property taxes jump to $21,000 and increase $425 a year thereafter, okay? So this is the value of Prop 13. What I did is I went out 25 years. With Prop 13, the child pays $80,000 in taxes. With Prop 19 on the residence, it's $200,000 higher. With Prop 19 on a rental, $600,000 higher. These are huge numbers. Of course, it's over a 25-year period. I think that you should think about acting now to protect Prop 13, have the meeting, figure out, do I need to do anything? You might not need to do anything, but at least you know, okay? And I would say probably 1/3 of our clients, or 1/3 of the people that we meet with don't do anything, about 2/3 do. So, and here's the bottom line. When you die, if everything's gonna be sold and your kids don't want any of your property, this Prop 19 is fantastic for you, right? Because you don't even care about if you don't have kids. You're not going to be passing on Prop 13 anyway. But Prop 19 is really actually fantastic for homeowners. I mean, this is a really good bill for people who have Prop 13 and want to move, basically. Let's look at the rentals. Lori buys a $100,000 fourplex in 1975. It's now worth $2 million. The current tax bill is a little over $3,000. After February 15, when the kids inherit the fourplex, the taxes go to $25,000 a year. Now, this is a fourplex in LA that has rent control. And let me ask you, for those of you who have rentals in LA with rent control, can you just raise the rent to any amount you want? No, right? You're capped at the amount of rent you can raise. And frankly, on some of these, it's going to gobble up that extra $22,000 in tax is going to gobble up a lot of, I mean, no pun intended, because it is the day after Thanksgiving. It's going to gobble up a lot of your profits. So Prop 19 means higher taxes when the property dies, but you can plan now to preserve Prop 13. Okay, so you need to think about acting now. Prop 13 versus Prop 19 over a 25-year period. When we run the numbers, it's $100,000 with Prop 13. This is after Lori dies and the kids inherit the property. It's another $740,000. You know, it's just a lot of extra taxes to pay. This is taken from the Board of Equalization. It was actually taken from a slide deck that an attorney shared with me, who we're going to be meeting on Monday. It's the LA County Bar Association. So if you're a lawyer, LA County Bar Association, estate planning section is having meetings. And I know there was a group in the Sacramento region who was having meetings as well. The parent to child, parent to grandchild exclusion, that's the current law and how Prop 19 changes it. Okay, so there is a lifetime limit of $1 million per person on your Prop 58. That's the parent to child reassessment exclusion, the amount of assessed value a parent can leave to a child. So a parent can leave up to, right now, can give, sell, convey, whatever it is, transfer up to $1 million in assessed value of property, in addition to the home, up to $1 million in assessed value of property, and not be reassessed. And then going back here, and that becomes effective February 16, okay? And there was an attorney who came up with a decision tree. This is kind of our decision tree that we go through, okay? This is, it's yes and no. You answer yes and no questions. I'm not going to go through this with you, just to know that we do have a structure to how we analyze these. All right. So we kind of look at each property on its own. And this is the reason we're doing this at our family meeting is you obviously need to talk to your kids. Hey, do you guys want to keep using the home in Tahoe? Do you guys want to keep using the beach house in Orange County? And if your kids all live in other states, they might say, no, Mom, but we might want to rent it out, right? So why don't we do a structure to save Prop 13 for the kids and do that now? And I'll go through some strategies here. So can you just give your property away now? Well, if the child is the client, as a lawyer, I might say, sure, right? If the parent is the client and asking me, should I give the property to my kids? I'm going to say no, right? Because you're going to lose control of that property. All right. It's simple. It's low legal fees. But you know, if you give your kids the property, they own it. Your tax basis carries over to them. Your tax basis for capital gains tax purposes. But if you're not selling it, capital gains really aren't, you know, the whole point of Prop 13 is not to sell the property. At least not yet, right? You want to keep that low Prop 13 tax base, but you may have a rental that a child would want to move into as their home in the future, and then take that tax base and then buy another property, as we discussed earlier. So, you know, your property subject to the child's divorce potentially a divorce, lawsuits, bankruptcy, you lose the rental income. And the other kicker is your child may die before you pass away. So This does happen. People do die out of order. There is a workaround if you have more than one child that we'll touch on. What are capital gains tax? Basis is your purchase price plus improvements minus depreciation. So your sales price minus your basis is your taxable gain. So if you buy something for $1 and sell it for $3, you're going to have a $2 gain. You got to pay taxes on it. At death, property generally, unless it's in a B trust or a bypass trust, at death, property generally gets an adjusted cost basis to fair market value at the date of death. So let's look at if Lori sold her rental. Let's say she says, I'm going to sell. I'm Lori. I'm 97 years old. I'm tired of, the tenants complaining about the leaky faucets and the plugged up toilets. I'm just going to sell it. Well, if she sells it, it's a huge gain, $1.93 million capital gain. That's going to be taxed at her current federal capital gains tax rate, basically $250,000 in taxes she'd have to pay, right? If she doesn't sell it and she owns it when she dies, you get an adjusted cost basis. So that capital gain goes away, zero capital gains tax, right? Because her $100,000, her lower basis, lower than 100 because of depreciation, goes up to $2 million. If Lori's married and her husband dies, and this is community property, Lori gets a step up in basis. So it's not uncommon when one spouse dies for the surviving spouse to sell property because they can and avoid capital gains tax. So should Lori give the kids her property? So here's kind of a problem. So if Lori gives her triplex to her kids before February 16th, they may escape reassessment, okay? Provided she hasn't used up her other, she hasn't already given away $1 million. However, they take Lori's tax basis on the property. So when they sell the fourplex, if and when they sell the fourplex, they're going to pay more taxes. If they keep the property and rent it out, they will not be able to depreciate from the stepped up basis. So they're going to lose not only on the sale, but an ongoing depreciation tax benefit. And if this is over your head, guys, if you're just looking at this like, what this guy's just talking about, I don't understand what this guy's talking about. That's okay. That's why we're here. That's why people come to us. They say, yeah, I'm kind of like Lori. I've got this apartment building. I heard something about taxes. I don't really understand what's going on. Help me out. It's a lot more, it's a lot clearer for clients when we're talking about your own stuff, not an example. So there has to be a better way. I believe there is a better way. And this is, we have almost 3,000 views on our YouTube video that we posted 2 weeks ago. And we talked about a Prop 13 trust. And I'm going to give you a little more, put a little bit more meat on the bone. So I'm going to be using some technical terms. If you don't understand those technical terms, that's okay. The technical terms, we have a lot of lawyers on here. I mean, a lot. And so a lot of this is for the lawyers. And what I'm doing is I'm treating this as an open book. I'm sharing my information. I think this is something that should be communicated very quickly. This is a very complex thing for lawyers to get their heads around. I will tell you, because the problem in researching this, here's the big problem, the very high level problem. In almost all the examples, people do not want to effectuate a change in ownership, right? So when you go look at the Board of Equalization's website, by the way, I did find out the reason, and this is from the Board of Equalization, the reason that the assessor's handbook was pulled off the website was not a nefarious reason, but it was not ADA compliant. Now, just take that. I'll just leave that, okay? But it is not on the website. We do have that, and if you'd like it, just reach out to me and I can get you the assessor's handbook. So, Prop 13 trust allows you to pass Prop 13 taxes to your children now, and you preserve Prop 13 for your children for their lifetimes, okay? You have to deed the property to the trust before February 16th. You're the grantor, meaning you're the person who sets it up. You're the person who creates the trust. Your children are the beneficiaries, and a change in ownership occurs. And I mentioned the problem is all the examples that we see in the Board of Equalization's materials is people not wanting a change in ownership. Well, now we flipped the switch. Now we want a change in ownership, okay? So before it was like, we're trying to do all these things not to get a change in ownership. It's like, if you don't know what a duck looks like and you see a picture of an elephant and you go, well, that's not a duck. And then you see a picture of a car and that's not a duck. It's kind of hard to know what a duck looks like when all you're looking at is things that aren't a duck. So Whether you can or should get an adjusted cost basis at death is case specific, because the bargain that you make with getting an adjusted cost basis at death is it's included in your estate. If you're a very wealthy person, you may not want that, right? So there's no one size fits all approach. Clearly, I've been meeting with clients. All the other lawyers have been meeting with people on Prop 19 issues. We've been meeting nightly after work by Zoom. And we have been sort of going through these cases and issue spotting. And this is very much like law school. So for those of you who are lawyers, and I mean, going through law school, you had study groups. We have a study group. And what we're doing is we're bringing up cases and we say, well, this is what this person wants. This is what I see. Does anyone else see anything else? And somebody else will chime in and say, well, have you thought about that? Have you considered this? And it's a much better way to get these cases done. So when you hire our firm, you actually are hiring all the lawyers to look at your case, which is kind of cool. So each plan is highly dependent on a much broader set of facts than a living trust. Yes, each living trust is custom tailored, but one kind of looks like the other. These plans, they all look different. There are common themes, but they're pretty much all different. So I call it a GET trust. This is an irrevocable trust that transfers California real property to the children. So if you're from the Board of Equalization watching this, this is what I call it. This thing doesn't even exist. I took a bunch of components and put them together. It's kind of like Taco Bell when they invent a new thing. Taco Bell has 5 ingredients, right? They get lettuce, cheese, beans, hard shell, soft shell, and they come up with all these new menu items. Well, basically, I've taken the tools that were available to me as a lawyer, and I built this new thing, okay? And it's a GET trust. It's a grantor irrevocable incomplete gift trust. So you might ask yourself, if you're a savvy attorney, a grantor incomplete gift irrevocable trust, why would you do that? There's no reason to do that. You'll see, you give something away, it's incomplete for gift tax purposes, so you don't have to file a gift tax return, and it's includable in your gross estate. And why wouldn't you just keep the property? Okay. The whole point is to effectuate a change in ownership and preserve Prop 13 for the kids, and have some tax benefit to this, right? And have the grantor, the parent, still be in control. Grantor trust, a grantor trust is taxed in your own personal tax return. So if I'm a living trust is a grantor trust, right? So if I set up a living trust, that's considered a grantor trust. I don't have to file a separate tax return. I report all the income on my own 1040. I can do an irrevocable trust that is a grantor trust. So if I retain the right to borrow without adequate security, and again, this is in the R&D mode, we have not confirmed that this is the relinquishment of this power will blow Prop 13, okay? But if you retain the right to borrow without adequate security, under federal law, all the income is taxable to you, okay? And you can report that on your personal return. That's a federal law issue. I'm concerned that if the parent has, by the way, if the parent has any right to collect rents, when the parent dies, that's another change in ownership. So you need to, as a lawyer, think about perhaps putting in there a negative statement that the parent does not have the right to collect rents. The power to substitute assets, which is a typical grantor power, I don't like that, because I think when the parent dies, relinquishing that power could be deemed a change in ownership. I don't like that in a Prop 13 trust. And the power to add charitable beneficiaries is frankly the power to change ownership in the property. So I think those are bad ones. And I went through all the grantor rights. Which one can a parent retain so that when the parent dies, it is not a change in ownership from the parent to child? A life estate, for example, when the parent dies, that's a change in ownership. So life estates won't work. So these, and I kind of went through all the things that might or might not work. I still have not gotten confirmation from the Board of Equalization that an irrevocable trust where the grantor has the right to borrow without adequate security, not a right to the rents, but the right to borrow from the trust, okay, on a loan basis. And typically loans, the way loans are treated by the Board of Equalization, Board of Equalizations are the people that basically tell the assessors how much to raise tax. They're the people that train the assessors on tax law. So they're kind of, they're like the state supervisor of the assessors in the state of California. So the, I haven't gotten confirmation that this is going to work. I'm hopeful that it will. Now, when the parent retains a personal right of occupancy, that causes inclusion in the parent's taxable estate because the parent is retaining certain strings, okay? And under federal tax law, if you retain certain strings on property, it is included in your estate. If it's included in your estate for tax purposes, that means you get an adjusted cost basis, okay? So that's a really big deal. And it's an incomplete, so there's no gift tax return. Now, how do we solve the problem if the parent gives it to the kids? If the parent has 3 kids and they give the property to the kids and one kid dies, that property is going to get 1/3 reassessed. How do we resolve that? Well, the kids in their trust, right? In this trust that with 3 buckets, they can capitalize an LLC, meaning the trust sets up an LLC. The trustee transfers these respective 3 interests into the LLC so that when 1 kid dies, there's no reassessment. But when 2 die, the property is reassessed because when more than 50% transfers, you get reassessment. So that is the GET trust. And I'm going to go through maybe a couple of questions here. We have a living trust where properties have been transferred and are to be maintained in trust with kids having shares of trust after death of trustors. Will these properties still be reassessed after death of trustors? Yes, if the death occurs February 16th or later. Is it possible for you to review the assessed value on your post Proposition 19 slide where you show the assessed value in the 1970s at 100,000, fair market value to $1.7 million, and then assessed at 200? I missed the analysis of how you, the assessed value is 200. Do you mind reviewing that aspect? Jennifer, here's what happens. If you buy a property for $100,000 in the 1970s, the most, starting with 1975 tax year, the most that the assessed value can increase is 2%. It's tied to it's tied to the California Consumer Price Index. So if the California Consumer Price Index goes up 4.5%, your taxes only go up 2%. That's how I got to 200,000. Can you transfer rental properties to LLC for adult children and save basis? Patricia, that's an interesting question. I'm not sure I totally understand that, but yes, you can transfer rental properties to an LLC. Oh, and save your Prop 13 tax basis? No. The exception is if you're an original owner. So if you have an LLC and the LLC buys a piece of property, as long as no one person gets more than 50% or no one has control, as long as there's no change in control or no one person has more than 50%, the property is never reassessed. Kind of cool. So going forward, if you're thinking, if your thoughts are, wow, well, how can we live in this Prop 13 world and still pass to our kids going forward? When you buy a rental property, an investment property, you should think about setting up an LLC and buying the property with an LLC, okay? If it's structured correctly, you can avoid reassessment when the parents die. Do we have special needs expertise in our Camarillo office? The attorney we work with left your firm. Yes, we do. We still do a lot of special needs planning. What if you have a multifamily rental property, disabled child living in one of your rental units? Can you gift the rental property to him since he lives there and retain the property taxes for the other rentals to help support the child after the parents are gone? Yeah, William, we can certainly do that. We can come up with a structure to protect Prop 13 and make sure your child is cared for. It sounded like there's no way out of this as it relates to vacation home, short of making it a primary residence. Yeah, Gary, that's the problem with this. So if you have a vacation home, you got the beach house and it's not your primary residence, you got to get on this now. And I would say that the people who are quickest to do this and most interested are the ones that do have the family sort of vacation home. And it's I'm going to read something. Somebody sent in a question, and I think this kind of captures what's going on here. It's from Kathy. She says, "Hi, I will join you the day after Thanksgiving. Thank you for addressing this issue. I know that super rich people have some kind of trust that includes their descendants and do not pay taxes like us poor people. There must be another kind of trust that puts the kids into it, but not active until I depart this earth. My husband and I worked hard all our lives so that we could leave something for our kids. I have 2, and I have 2 houses. One that we lived in San Diego and are now renting it, and the other one is my home in Torrance. Both are worth now over $1 million. If the kids decide not to live in them, they will not be able to afford them, and the rent would be sky high. These are regular houses that inflation has put them out of reach of the average American. If I understand the tax code, the taxes would increase about 6 to 10 times the current taxes. To me, this feels like the government is stealing anything of value that we own. I know this is not happening to the Kennedys and the Rockefellers or Bill Gates or Elon Musk. I hope you can address this issue. That's kind of the point. I mean, that letter really encapsulates what's going on. People who have owned property for a long time in California, many of these people could never afford to buy the house again. You couldn't afford the taxes. You couldn't afford to buy it. And that's why a lot of people, that's why a lot of people leave California, quite frankly, is because they can't afford to live here. And so preserving Proposition 13 preserves the ability for, your kids to live here. And frankly, for you to be close to your grandkids, because I don't think, if you want to see your grandkids, you probably don't want them moving to Texas or Nevada or wherever they're going to move to, right? But this Prop 13 is very, very important property right. And it's a little sad to see it go away for a lot of, it's really sad for a lot of people. So, all right, what options for the family legacy vacation property? Have one right now that the grandfather built and is now owned by 14 descendants. The current fair market value is about $600,000. Thinking of using an LLC. Yeah, that's possible. Daniel asks, if my mom has a rental that she did a 1031 exchange to get into, are there any other considerations to consider? She gives it to the child now to take advantage of the exemption before February. Yeah, Danielle, you should make an appointment and visit with us. And I think we can set up a trust where the parent stays in control of the trust, and the parent and the child becomes the owner. So you have that change in ownership. So you trigger the change in ownership, but the parent maintains control. So I think we can help you out there. Micah asks, the property under Prop 13 currently with 2 generations on title split 50-50. What is the assumed risk to tax once the child inherits 100% of the property? The tax is based on 1949 purchase price. Yeah, that's Micah. You're going to want to reach out to us. We'll have to just consider that, kind of take it as take it as one of these individual cases. And as you can see, all these cases, they're so different. It's really hard to give a kind of a general plan that applies to everybody. So Holly asks, so if I don't do anything and pass on less than $1 million to each of my child, including the home, is the home reassessed or not? Holly, the home, your home that you're living in, when you die, there's a change in ownership. The property is reassessed unless an exclusion applies. So the exclusion would be a child making your home that child's home. Now, if you have more than one child, I don't know how you're going to settle up with the kids and make it fair. So the home might be partially reassessed. It might be fully reassessed. If you're renting that home out and then you go to assisted living and you rent the home out, then there is reassessment when you pass away because it's not your home anymore. And it's very common for people to do that. So, I would say best practices, if you're taking care of an elder and you're thinking about renting the home out, check in with an expert lawyer and say, hey, how's this going to mess up my Prop 13? Mom's 89, we moved her to assisted living. I want to move into the home when mom dies. We may need to transfer that property before it's turned into a rental. And you may have to move in there. So Melanie asks, can you explain Prop 13 versus Prop 58? Prop 13 is the property tax system in California. It's how property is taxed. Prop 58 lets a parent leave Prop 13 to the children. So that beneficial Prop 13. Elizabeth asked, does a GIT trust trigger capital gains? No, because it's a grantor trust. And sometimes you can do this with a sale. Sometimes you can do it with a gift, but it does not work. It does not trigger capital gains tax. How will Prop 13 trust work with commercial property? So with commercial property, you would transfer that property into a Prop 13 trust, and the children would be entitled to the rents. Now, the trust could accumulate that cash that is taxed in the grantor's 1041, right? So if you're the grantor and you have commercial property, you put it in the trust, all the tax benefits still flow through to the grantor. The grantor can borrow from the trust. This is just what we're thinking, right? So this is kind of real time in the sense that we don't know if this will work or not. but the parent could borrow without adequate security from the trust, as long as they're not taking the rent. So if you're taking the rent, and then when the parent dies, that's going to be a change in ownership. So you would have to follow the rules, basically. With so many uncertainties at present, how can anything definite be done now? Well, the nice thing about this grantor trust, the GET trust, we are likely going to be doing a lot of these in January. That gives us a full year to modify the terms of the trust. It gives us a full taxable calendar year. By the end of the year, we will know. I'm sure the legislature is going to pass enabling legislation for this constitutional amendment and be answering a lot of these questions. Does any of this apply to agricultural farmland? You know, I don't know enough about it I don't know enough about the law focusing specifically on farmland, but it does. So there is a farm exemption. I did see in some study group that there is a carve out for farmland, but it's unclear what that means. So it's if you're producing agricultural commodities. And so, you know, it just depends on the use of the land. And again, we're waiting for the legislature to really define what this is. Gene says, I'm slightly confused. Is a right of occupancy allowing transfer now, but allowing a step up at death? Yes. A reserved right of occupancy, there's the Linderm case, Linderme from 1969. It says if you live in the property, it's included in your estate. If you have a right of occupancy, it's included in your estate. When the parents die, will the loss of the retained personal right of occupancy be a change in ownership for property tax purposes? No, that is black letter law in the Board of Equalization. If you go to the Board of Equalization's website and type in personal right of occupancy in the search bar, you're going to see some rules come up that say the extinguishment of a personal right of occupancy is not a bare right of occupancy, is not a change in ownership when that extinguishes. A right of occupancy coupled with a right to rents is a change in ownership. So rents is really, really important to pay attention to that. If the GET trust fails for Prop 58 purposes, since the goal is also to retain the step up in the state inclusion, is your theory that the worst case scenario is that the property would be reassessed at the parent's death? Yeah, I mean, again, I'm not going to do something that we don't know. We're only going to do stuff that we know is going to work. It may mean that it can't be a grantor trust, right? And that just changes how the trust is administered. But clearly, it is. We do know that if you transfer property to an irrevocable trust, because we've been doing this for years with Medi-Cal planning, okay? You transfer property to an irrevocable trust, you retain a right of occupancy, that's a completed gift, okay? That is a change in ownership. So a parent transfers the property to the child and retains a personal right of occupancy. That is a transfer for property tax purposes and included in the parent's estate for federal estate tax purposes, and it gets you an adjusted cost basis. We've been doing that type of planning for as long as I've been practicing law. How does a limited power of appointment impact this? Leslie, not sure I would be putting a limited power of appointment in there. I would just be concerned that it might be exercised. So the exerciser of the limited power of appointment is deemed the grantor for Prop 13 purposes. It actually may not matter if there's no parent-to-child reassessment exclusion. That may be case specific. Who's the trustee of a GET trust? It's typically going to be the parent. I mean, it could be the kids. Melanie asks, if you sell rental and utilize a 1031 exchange for a new property, do you preserve Prop 13 basis? No, because if you sell a rental and use a 1031, that is a change in ownership. So whatever you buy is going to be at the new higher tax rate. A lot of people, when they do 1031 exchanges, they buy out-of-state property. I mean, a lot of them buy in-state property, but we see a lot of people buying out-of-state property because you get a higher you get a higher rate of return. Shilpa asks, for many older people, they are living off the rents of their commercial properties. If they were to assign the right to collect rents to their children, they may have limited cash flow. How can they pass the commercial property to children, but allowing them to preserve their cash flow? Great question. And that may be the power that maybe you would do some, maybe you transfer some. Some people are also limited by the $1 million assessed value. So you may not transfer all of them. You can then also capitalize a partnership, right? So let's say you transfer your homes to this GET trust. The trust then capitalizes an LLC, which is taxed as a partnership, and you're the manager, and you're getting comp. You're not getting rents. You're getting comp. You also get still on a grantor, with a grantor trust, you're also getting the tax benefits of owning the real estate. If President-elect Biden does away with the step up in basis, will this be retroactive? Will Congress have to approve this? Yeah, so doing away with the step up in basis would be a change in federal tax law that requires a bill to be passed by Congress and the president to sign the bill into law. So he cannot do this with an executive order. It will be retroactive in the sense that any transfers, any deaths occurring in a given period of time, not this year, but potentially next year, right? Any deaths, there would be a limited basis adjustment. And what I've seen is the limited basis adjustment is $3.5 million, gets a step up in basis, but everything up but beyond that does not. Can you say more about the sweeteners for people over 55, disabled, or victims of wildfires? Specifically, how will Prop 19 and GET trusts apply in third-party special need trust scenarios? Jessica, that's a tough one. That's kind of out of the scope, but I think you're correctly identifying the issues there. Janet asks, what if you set up a GET trust, but then, for example, in 2022, the feds eliminate estate and gift tax and instead go to a mark-to-market style type of transfer tax system at death? Yeah, I mean, you could, you have a trust protector in the trust, and the trust protector has the power to change trusts. You could decant the trust into a different trust. And this is why people say, I don't want to deal with that trust. It's too complicated. I'm just going to give the property to my kids. The problem is you lose a lot of really great planning strategies that are available with trusts. So trusts are this weird intersection of tax law and estate planning. And you have a lot more flexibility for tax planning versus an outright gift. Are you then making a distinction between life estate and parents versus a right of occupancy for parents? I thought you had to say life estate was not okay, but right of occupancy is. Teresa, yes. A life estate is terrible for Prop 13 planning right now, okay? A life estate's terrible. A right of occupancy is what we're looking at. And then Peter asks, hey, Peter, if a person dies February 10th, so 2016, does Prop 58 apply even though the transfer is not completed with the transfer deed prior to 2/16/21? You know, that's a tough one, Peter, because death is the change in ownership. I would argue that the change in ownership happens at death. Now, the question is, can you make a claim for reassessment exclusion between parent and child after February 15th? I don't know. It is possible the legislature can say, you can't make that claim, but it depends. It just depends on what the law says going forward. That is a question I don't have the answer to. What we are doing on our trust administration practice is we are getting all these done quickly and out the door. We're not going to wait around. Does a GET trust protect children's creditors during the parent's lifetime? Yes, that's one of the reasons people do irrevocable trust is creditor protection. And Dan asks, I'm a little confused. For the primary residence transfer from parent to child, is that fully exempt from the reassessment? Or is it exempt for the first $1 million and then there's a reassessment for the difference? Okay, Dan, current law until February 16, 2021, current law, you can transfer a home of any value to the kids, a residence of any value to the kids. The kid does not have to move in there, and the child takes the parent's Prop 13 tax base. February 16 and later, that same deal, that same transfer, now the parent has to check the homeowner's exemption box, right? So this is the residence, and the kid has to as well. So the kid has to move into the property, has to be the homeowner, and the parent can leave the child the tax base plus $1 million. And if the fair market value is more than the tax base plus $1 million, the overage is reassessed. We should simply call Prop 19 and Biden's proposed elimination of the step-up basis as the 2020 and 2021 Modest Wealth Destruction Act for California. I like that. All right, Gene says, if we did a precious Medi-Cal plan with life estate recorded, it sounds like we now have to choose between protecting the property tax with a complete transfer now versus accepting the $1 million plus current basis and hoping for a step-up in basis. Gene, that is what is keeping a lot of lawyers from getting a full night's sleep, is they think about all the life estates they did, they think about all the old Medi-Cal planning they did, and how on earth are you going to reach out to your clients and share this with them? How how are you going to do this by February 15th? Okay. All I can say is I completely understand what you're thinking. But there are a lot of older Medi-Cal plans. Basically, what we're talking about with Medi-Cal planning is people who go into a nursing home. A lot of times they do special planning to put those assets in a trust so they're not counted against them for qualifying for paying for a nursing home. And a lot of those plans are really going to be a disaster with Prop 19. Any chance Prop 19 can be overturned by the legislature or the courts? No, Prop 19 is an amendment to the Constitution. It would require another amendment to the Constitution. All right, so sometimes a completed gift is better. You have 11.58 million, right? You have 11.58 million in tax. Hold on, whoops. Here we go. Sometimes a completed gift is better. This is for a rich person, okay? Here's the problem. If you make a gift, and there's something called the basic exclusion amount. So right now it's 11.58 million. A lot of people are worried that with Biden, it's going to be cut down to 3.5 million or less. All right. But if you make a gift, if you make a taxable gift, it comes off of your is called your oldest basic exclusion amount, right? Which is at 3.5 million. So the bottom line is if you give $2 million and there's a $3.5 million Biden exemption, that's coming off the $3.5 million Biden exemption. It's not coming on the difference between 3.5 million and 11.5 million. Sorry to say, a lot of our clients are doing something called a Spousal Lifetime Access Trust. A lot of our rich clients, that's where they use up, they make a gift of 11.58 million to a spouse in a trust, and they use up one of their exemptions. And some of our clients are using both of their exemptions, of very wealthy people, because the gift tax exemption is 11.58 million. It used to be $1 million. So now is a great time to, if you're thinking about, if you're wealthier and you're thinking about making a big gift to your kids, you really need to get on this. We're frankly running out of time. All right, so some other strategies. A richer person solution number one, if somebody says, I don't want to use up a gift exemption and I don't want the property included in my estate, okay? You use something called an IDGIT, which is intentionally defective grantor trust. I'm not going to get into the details on this. This is a slide from the presentation that'll be done on Monday at the LA County Bar Association. So for those of you lawyers out there, I just would really caution you. The grantor trust powers, you really need to pay attention to those, because I think when the grantor dies, some of those powers are likely going to be deemed a change in ownership. Okay, so that's what the grantor sells the property to an irrevocable trust that is a grantor trust. Because it's a grantor trust, there's no tax. There's no tax paid, because you're basically selling it to a trust where you report all the income on your own tax return. So there's no realization of capital gains tax. You can couple it with the SKIN, a self-canceling installment note. Anyway, that's just a richer person solution for the lawyers. You know what I'm talking about there. Gift tax return, Form 709. If you make a completed gift, you have to file a gift tax return. The gift exemption is going up to 11.7 million in January of 2021. You deduct this from your lifetime 11.58 million. 2026, it goes down to 6.58 million, plus an adjustment for inflation. So go to Cunningham Legal, make your appointment with us. And if you go to make an appointment, someone will call you on, not this weekend. Or people actually need to take the weekend off. Someone will call you on Monday to book an appointment. So should you seek advice? Okay, if your kids are going to keep one or more properties as a rental, and I know I'm going through a lot of dense stuff kind of quickly, but if your kids are going to keep properties as a rental, a vacation home or primary residence, gifting strategy should be strongly considered. Really look at those. If your kids are going to sell everything, you're like, well, I just wasted a whole bunch of time, but you didn't, because Prop 19, there's a lot of good stuff in there about where you can move and take your property tax base. So even if you don't have kids, this is very valuable information to learn about. But if your kids are going to sell your real estate after you pass away, preserving Prop 13 may not be an issue. Okay. That's how you go to book an appointment. So here's here's some kind of takeaways. This is not for amateurs. This is not a DIY project, not a do-it-yourself project. There are no readily available, easy solutions. You know, you got to ask yourself, are you in a position to give away your real estate? One question was, hey, you know, a lot of people are living off the rents. You might not be in a position to give away your real estate. You might not want to. Are you financially secure? If you're, you know, this planning might not be for you, but I think it makes sense to talk to an expert, because the window of time is narrowing, and you need to know. The whole point of this meeting with one of our attorneys, by the way, is to find out, hey, should I do something? Is there something I should do beyond this? So you got to be really careful. Again, I advise against deeding your property to your children without a solid plan in place. We've just seen too many instances where people end up treating their parents poorly, frankly, or they lose the property in a divorce or bankruptcy. Life estates won't work. That's just pretty straightforward. If you might still need the income from the properties, that's an issue. If your child passes away before you do, what if you change your mind? What if you have a change of heart? You're like, hey, I don't want to do this. We're just going to sell the property as a parent, but I want all the money back, right? So these are some issues. If you might need a ripcord in the plan where you end up getting the property back. So you really need to pay attention to your estate plan, because when you create a Prop 13 trust, that property is no longer yours, right? It's not yours, it's your kids. And you need to make sure it's consistent with, your estate plan is consistent with your Prop 13 trust. And by the way, by doing this, there is the potential, if you don't do this correctly, where you could cause a realization of capital gains if you were to make a transfer. You know, B trusts are problematic when a spouse passes away and there's a B trust. If you start monkeying around with some of these entities or places or entities or trusts that own property, you can trigger capital gains tax. So you need to be careful. So B trust, you may want to consider terminating your B trust and distributing that property to your children now, because there's no more parent to child reassessment exclusion. Okay. So if you have that apartment building in the B trust, and you know that when you pass away, your kids are going to want that apartment, you may want to consider terminating the B trust, because when those kids inherit that property in, after February 15, 2019, the kids will be reassessed. So you may want to consider terminating that B trust, and there's a process to do that. So what can you do after February 15, 2021? Consider purchasing real estate by an entity, such as an LLC, taxed as a partnership. When the owner of an LLC dies, many times reassessment can be avoided if it's originally purchased by the LLC, and nobody gets more than 50% ownership or control. So very important. So you and your son purchase a home for $1 million and rent it out. You purchase the home in an LLC. Now the home's worth $3 million. Your children each acquire a third interest in the property. There's no change in ownership. Good deal, right? So that's kind of a takeaway from today. If you have one child, your son acquires 48% in an entity, your daughter acquires 48%, and your grandkids get 4%. No change in ownership. That is what happened in the Michael Dell case with the Fairmont in Santa Monica. So go to Cunningham Legal, set up a Zoom consult. Consultation fee is $500. Collect all your recent recent property tax bills, so the most recent ones. Get your current estate plan and get those two things to us before your meeting. We need to look at your estate plan. We need to look at your property tax bills. At the end of the meeting, and it's a 1 hour meeting, and we typically go right up to 1 hour, you will know whether to take further action or not. And again, about 2/3 of the time people take action, and about a third of the time they don't take action. So, and obviously there are additional fees, and they're all over the map, quite frankly. It just depends on what we're doing. So this concludes the Prop 19 portion. So if you were here for Prop 19, we're going to also talk about caring for a loved one who needs help, but who's alive, and then what happens when a person passes away. So let me go through the rest of these Prop 19 questions, and we just have a few questions here. Wendy asks, should I worry that since the recorder's office is already weeks or months backlogged, that we already don't have time to set up a trust and file before the deadline? No, our firm uses an electronic service that gets them recorded. And also the rule is it does not, the deed has to, the change in ownership has to occur before February 16th. And there's an argument that it doesn't have to be recorded, but I just am hesitant even to say that because a lot of other stuff has to happen. If the property is bare land, how would a right of occupancy even be relevant? I presume it could be the right to enjoy the use of the land. Can the right be non-exclusive? Dennis, these are non-exclusive personal rights of occupancy. So you don't have the right to occupy and collect rents. That is a form of occupancy. But if it's bare land, you have the right to, drive your truck, do donuts on the bare land, put out your tent under the stars. Why a full year to modify the trust terms? A full year to modify the trust terms because if for a grantor trust that is reported on the client's 1040, and that's a January to December tax year. So if these are signed and funded in January, we have a whole year till the December to change the terms of the trust, right? Whether it should be grantor or non-grantor. That's why. Versus if you do it in December, and also that year, by the way, 2021, we will have more definitive results in. We'll know what the rules are because we don't know what the rules are because the legislature is going to be convening in January. Sandra asks, mother passed in 2018 and the house is in the trust for 3 daughters. The house is still in mom's trust. The house is being rented. One daughter passes while the house is still in the trust. Trust says daughter's 1/3 share goes to her heirs. How does Prop 19 apply? If the death happened before February 16, 2021, there's a reassessment exclusion. I mean, I'm making an assumption on how the trust is written. So, but with Prop 19, 1/3 of the property would be reassessed. So Sandra, in that case, what you might consider is the trustee with the 3 daughters as beneficiaries, the trustee creating an LLC and putting that property into the LLC. So that would be owned by the trust. Well, really it's owned by the 3. It's owned by the trust for the benefit of the 3 beneficiaries so that if one dies, you don't get reassessment. If 2 die, you're fully reassessed. So that's just the way it is. What's the implication if the parent retains the right to rental income? If a parent retains the right to rental income, Gene, when the parent dies, the extinguishment of that right to collect income is a change in ownership. So if the parent dies after February of 2021, the property would be reassessed. Eden says, I was unable to get on the meeting at the start for Prop 19. Is it recorded? Yes, we'll be posting this, I believe, this weekend, Saturday or Sunday. I lost a rental and the Woolsey Fire land is left. How is Prop 13 reassessment handled? Richard, I don't know because this is effective February 16th. I'm assuming it would be retroactive. I'm assuming, but I don't know. Again, we'll know more when the legislature meets. Janice says, if the property is the sole asset undergoing a current probate proceeding, will the date of transfer, oh God, will the date of transfer for Prop 19 be the pre-February 16, 2021 date of death or the post-1521 court order at the close of probate? So the question in here from Janice is, how does this affect people who are going through probate? Here's my quick answer. Death is a change in ownership. The change in ownership occurred whenever it occurred, right, before it's effective. One thing, Janice, you may want to do is talk to your client about filing the claim for reassessment exclusion now before the matter is finalized. But again, the issue, if it's an intestate succession, the change in ownership occurs at death. And this is a question for the Board of Equalization. Wills are admitted to probate on a certain date. The change in ownership, I'm assuming if it's a will, is still the date of death. But the problem is that and this is a problem with wills. Wills are a piece of paper until you get an order from the court saying it's the person's last will. Does that relate back to the date of death, or does it relate to the date that the will is admitted to probate court as the decedent's last will? Interesting question, right? I would suspect it's probably the date of death. That's consistent with the law. Before the end of the webinar, can you tell us how long out you're booked for the 1 hour, $500 review? I think we're booked through mid-December. And I haven't looked at it, but we're calling people back over the weekend. And if you've called us or reached out and haven't heard from us, I do apologize, but We are setting up each of these as their own matter, which requires a lot of internal work for the firm, and it's just hard to get through them. I would say you would be, it says, yeah, we reached out about a week ago after hearing your prior webinar center information, received a voicemail back from someone at your firm and would call you back. You should call on Monday, William, and get an appointment. Just call in and ask to make an appointment. We are getting back to everyone, but it's a cumbersome process. And unfortunately, we don't have online booking. We just don't have that functionality. Grant asks for a wealthier grantor. If capital gains tax is not an issue as to the grantor, would a sale to an LLC, which will be capitalized by the children from prior gifts, be a safer approach? No lifetime exclusion remains, so we don't want inclusion. And grantor trust LLC manager and children members to allow grantor to stay in the house and pay rent. Grant, I would say give us a call, set a time to come in. I think if you are transferring, that may be an instance where you would want to do a sale to an intentionally defective grantor trust, and then do something else with the note. And what that does is that shifts the basic benefit is the sale to an intentionally defective grantor trust. I hate that name because it says defective, but that effectively freezes the value of the property. So any increase, you can get your Prop 13 exemption, and then any increase above that goes to the kids, and then you're liable for the taxes on your own 1040, so it further depletes your estate. So Grant, just you probably want to set that one with me, but go ahead and call in. What if we modify, Janice asks, what if we modify the B trust to make kids present beneficiaries with the surviving spouse of the sprinkling income rather than merely terminating the B trust? I think if the problem with the B trust is all the B trusts say the trustee has discretion to distribute to the surviving spouse trust income and principal for health, education, maintenance, and support, typically, right? That includes the rents. I think that makes me a little nervous, the sprinkling of income, because when the mom dies, that could be a relinquishment of that power and the full thing gets reassessed. That wasn't an issue before, right? Because we had the parent-to-child reassessment exclusion. We didn't really think about it. If you create an IDGIT, would that protect the properties from Prop 19, or would you also need a Prop 13 trust? How do they work in conjunction? I would say it would be an IDGIT with Prop 13 functionality, where we're intentionally triggering the change in ownership, but we are for Prop 13 purposes. But when the parent dies and when that power is relinquished, it is not an additional change in ownership. You keep referring to the $1 million on top of the assessed value being transferred, but what is the $1 million based upon? Is that the assessed value of the transferor, the deceased parent, or the transferee? The $1 million, Ashley, is market value. So the example I gave was a home with an assessed value of $200,000 and a market value of $1.7 million. The $200,000 goes to the kid. The next $1 million in value goes to the kid. So you have $1.2 million in value that transfers, but your tax base is $200,000. Amounts over $1.2 million, that $1.7 million in the example, that $500,000 is reassessed, and so now it's another $6,250 in taxes. What about using a ground lease, gift to the ground to the kids and keep the building? The problem with ground leases over 35 years can be problematic, and those are changes in ownership, and that's something we can talk about. Terry asks, I have a living trust and a special needs trust with the beneficiaries being my disabled autistic sons who cannot work. Will a GET trust help protect my property tax basis? Home is worth $2 million now. It probably will. It depends on when we do the math. But Terry, I would say go ahead, make an appointment and visit with us, and we can go over that one-on-one. Janet asks if you have rentals not under Prop 13 and taxed at the current market. Janet asks if you also have rentals not under Prop 13 and taxed at current market value, does an heir need to live in one of them? Well, on that one, you do have Prop 13 if you have rentals in California. It just may not, if they're recently purchased, it may not be this really good benefit for you right now. It may be a future benefit. The problem is rentals after February 16th, if it's a rental, it's going to get reassessed. So it's only the house, only the residence that avoids reassessment. Marcella says, thank you. Thank you, Marcella. Anonymous says, can you create an LLC to purchase properties moving forward without having a business solely for the purpose of acquiring properties? Yes. An LLC is for business purposes. If you buy a rental, that is the business, right? I mean, that's perfectly fine. And then we have some other questions. Okay, so we're going to move on to, and we had two other longer questions, Mark and John. It looks like those are it's kind of lawyerly stuff. I would just recommend that you guys attend the LA County Bar Association's meeting that's coming up on Monday, and you can just go ahead and you can shoot me an email, jim@cunninghamlegal.com, and I can send you some information on that. So jim@cunninghamlegal.com. So caring for a loved one who is living but needs help. Very, very important issue. Well, actually, Karen asked, do you feel that Prop 13 itself someday will be taken away? I think if Prop 15 had been publicly traded companies don't get Prop 13, that probably would have passed 95-5, okay? Apple owns property, reassess Apple. Exxon, Chevron owns property, reassess Chevron, right? But you get these the people who are just trying to eke out a living with rentals, you know, that's kind of ridiculous. So I think Prop 15 would have passed. So to answer your question, Prop 13 for homeowners, I don't think it's going anywhere. If anything, it's going to get stronger. Prop 19 has strengthened it. In terms of commercial and industrial property, potentially. Residential, I see that as as much as they would like to eliminate the Prop 13 for residential, I can see an argument why you really would want to keep it because, people need a place to live. So you're going to take care of your parent's person or their estate. Okay. So this is, the taking care of the person is making sure that they're safe, making sure they're getting food. Estate is their money. Okay. So let's talk about their person. Advanced Healthcare Directive. These are documents a parent signs naming a person to make healthcare decisions for them. You can name a successor. You can talk about end-of-life decision-making. If you haven't talked to if you're a parent and you haven't talked to your kids about whether you want to be on life support or not, you need to be a better parent, okay? You need to talk to them about this because this is I would say this is one of the hardest decisions that people have to make with a parent is terminating life support, these end-of-life decisions. Very difficult. Tell them what you want. It's like, you know what? Pull the plug if I'm a goner, fine. PULSed is a physician's order regarding life-sustaining treatment. A PULSed is different than an advanced healthcare directive. An advanced healthcare directive is a legal document. A PULSed is a medical order. What that means is they stick that pink sheet next to your bed or on your refrigerator, and if you're choking on a peanut, they're not going to give you the Heimlich maneuver, right? Whatever it says. And I don't mean to be flippant about it, but I'm trying to make a point is the person who's caring for you looks at the medical order and says, do this or don't do that. An advanced healthcare directive says, contact my son to make decisions for me. Okay, so slightly different. HIPAA is the medical privacy. That's something that, sometimes you have a standalone HIPAA authorization. So sometimes the trustee might need to access medical information, but you don't necessarily want your trustee making healthcare decisions for you, right? But sometimes they need to access your medical records. We have, and there's a YouTube icon here. We have recorded YouTube on our YouTube station or YouTube channel, Cunningham Legal. Please go there and subscribe to the YouTube channel. That way you'll be updated on new videos, webinars. We have about 100 videos on our YouTube channel. And we have one starting the long-term care conversation. And I did this with the head of a local assisted living facility. And my mother-in-law passed away this March after having dementia and Alzheimer's for a long time. When my wife saw this, she was like, I wish I would have seen that when I started taking care of my mom. So it's just a lot of good stuff. It runs about an hour, but I would really recommend that you take a look at that. And it's how to talk to your parents about long-term care because it's a really difficult topic. What is the cost of long-term care? In-home care. We have another webinar coming up. We have another webinar coming up in December. Total mind blower when I found this out. I've been practicing law 26 years, and it's really cool when you learn new stuff. So I was talking to the lawyer who I'm going to do this with, and she says, if you're the kid and you're telling the caregiver when to feed your parents and the medication and how to do laundry, the kid can be deemed the employer. And you have no employer-employee relationship. The child who's trying to help the parent can be deemed the employer in California. And I'm telling you, the single biggest violation is wage and hour violation. They didn't take their 2 breaks during the day. They didn't get their half hour for lunch after 5 hours. And maybe they worked an extra hour for 3 years. A lot of these, I mean, we've had many clients pay out 6 figures when they've kind of hired their own in-home care and don't follow California labor law. These are elderly people that get sued. They go get a plaintiff's labor law attorney and they sue the elder. But that's in-home care. That ranges 20 to 30 an hour. I would go through an agency. Don't even try doing that on your own because they take care of all the paperwork, make sure all the taxes are paid. You really are, it is an employee and all those labor laws do apply. So, and then you have varying levels of care. It goes up. Assisted living is where people, they have a room and then they go to a common dining facility and their activities. But people are healthy and ambulatory, maybe taking their own meds, might need some assistance with meds. Memory care is where people, the difference between memory care and assisted living is memory care is locked so that people cannot leave. Because sometimes people will wander. Skilled nursing care is yet higher. Skilled nursing care is a higher level of care, and it's more money. Rehab is about $27,000 a month. So when my mother-in-law fell and broke her arm, she went to the hospital. That's $10,000 plus a day. Then she was discharged to rehab. That was $900 a day until they rehabbed her, physical therapy, occupational therapy. And then once she kind of leveled off, then they kicked her over to skilled nursing care. And that's where she got recovered enough to go back to memory care, right? So it's this whole like wheel that you get on. And for those of you who are taking care of elders, it's literally a full-time job. I mean, the stuff my wife went through taking care of her mom, it was just, just kind of a bummer for 2 reasons. One is you see your mom kind of declining, but secondly, my wife was the one doing a lot of the work. So she said, when she found out that you can get long-term care insurance, she's like, we need to get that because I wish my parents had it because they would have more money. And then I could have hired more help to do things, like the laundry and the cooking and the cleaning that she was doing, instead of having money to pay for that. And then she could have spent more quality time with her mom. So long-term care insurance on a high level, there's an old way, which is use it or lose it. You pay $500 a month or whatever it is. And then the new way, it's where you pay a single lump sum. And if you don't use it, your kids inherit the property. So the old way is you pay $500 a month forever. The new way is you write a check for $50,000 and you get $150,000 in coverage. The new way is if you don't use the $150,000 in coverage, the $50,000 passes to your kids. So that's just on a very high level. We do have a webinar on long-term care insurance on our YouTube page. And so just go to our YouTube page. Again, you can subscribe to the YouTube page, but if you're like, wow, long-term care, mom and dad really need that, go look at this. This is a really good webinar and we cover a lot of ground and give some examples. So taking care of your parents' estate. Now remember, this is while your parents are alive. So this is your parents are alive, but not doing well. And you're going to take care of their estate. So you're a trustee or an agent under a durable power of attorney. I'm kind of lumping all these together. First of all, you don't have to do it. Okay. The 13th Amendment to the United States Constitution prohibits involuntary servitude. All right. It ended slavery finally. And you don't have to do it, right? Is the bottom line. So just because your parents ask you or tell you, you're free to say no. But if you do, if you choose to accept this mission, you are 100% personally liable for everything you screw up, right? Everything you do or don't do or should have done or shouldn't have done, you're 100% personally liable. You're on the hook. The money isn't yours, okay? You're a fiduciary. It comes from fides in Latin, fidelity. You have to put the interests of your parent above yours, okay? You are legally accountable. There's a case called Geraldine, which says you have a duty to account when your parent dies and your jerk sibling can make your life miserable, okay? These are very common cases where after mom and dad die, the kid, the child who's taking care of mom, paying the bills. When mom dies, the jerk brother comes in and wants to know how every nickel was spent. Okay. That's an accounting issue. So when the settlor mom of when mom appoints during her lifetime, someone other than, well, himself, herself, oops, another typo. If mom appoints you as trustee and the trustee is irrevocable, the kid, their other beneficiaries, including your jerk brother, have standing to sue. Okay, so this is while your mom was alive. Breaches of fiduciary duty. So action items, watch our YouTube videos. So if any of those resonated with you, keep a copy of your parents' advanced healthcare directive. Very important that you keep a copy of that, because COVID, you're not going in the hospital. They're not going to let you in if your parents go to the hospital. You need to have that document in order to help them out. Consider long-term care insurance before age 86. You get it up to age 85. Get expert legal counsel before serving as trustee. This is very important. You do it before, not after. Don't DIY it. It's not a do-it-yourself project. Don't start it and then go to the lawyer's office. You need to check with the lawyer before you start serving as trustee. You need to know what you're getting into, okay? And sometimes people, after they meet with us, they're like, I'm not doing it. Someone else is going to do it. Keep immaculate records. I really mean down to the penny, okay? So after somebody passes away, what does a trustee do? Well, you manage assets for beneficiaries. It's not your money, right? It's their money, and you act on their behalf. So you are accountable to them. You cannot drop the ball, okay? You've got a lot of stuff to do. If you're the trustee and you're the one that mom and dad has said you're going to handle everything, and you pick up the ball, don't drop it. You can't do it for a while and say, I'm just not going to do it. No, I'm not going to resign. I'm just going to stop working on it. No, you can't do that. That's not right. Okay. And you might get sued. You might get removed. You might have to pay money out of your own pocket. You have to follow the terms of the trust. Number one is you have to find the right trust documents. So we did have a case where some people, the parents redid the estate, right? The estate plan. And the son didn't know, and he's the only child. He didn't know. And so they waited 2 years and they missed out on some really good tax benefits because of that. You need to understand the terms of the trust. Now, the problem is trusts are written in legalese. They have language that lawyers call boilerplate. Boilerplate is not useless information. Boilerplate is actually very well-crafted technical terms that are in a trust that are very important, okay? And you need to understand those. And so it's very important. That's why I say you need to reach out to the lawyer before you become trustee, and you need to go over that trust, because every trust is different. And this is one thing people that don't practice in this area of law don't really understand. There is no set form for a trust. Powers of attorney, there's a uniform statutory form power of attorney. There's a statutory form advanced healthcare directive. You fill in the blanks. There is no statutory trust. So all these trusts are written, you go from one attorney to another, they're going to be written entirely differently. So you need to follow the terms of the trust, right? You don't wing it. Don't guess, not a do-it-yourself project. You can't say, I don't like that term in the trust. I don't like my brother. He shouldn't be getting mom's, silverware. I'm going to keep that for myself. No, you have to follow the terms of the trust, okay? You need to keep the beneficiaries informed. This means communication. So this is after mom and dad have passed away. You still want to get together for Thanksgiving. Maybe you don't. I don't know. Maybe you hate your siblings. Even if you hate your siblings, you still have to keep them informed. And sometimes beneficiaries will say, mom and dad die, and at the funeral, a beneficiary is a person who inherits, an heir. You might use in common parlance. They walk up to the trustee and they say, I know mom and dad have passed away and it's only been a week, but I really need some money. Can you advance me some money? Be kind, listen, check with the lawyer first. Sometimes we can advance money and sometimes we can't. Okay, so it's very important. But before you, or somebody will say, hey, can I drive the car? Mom and dad had this car and I don't have a car. Well, you need to add that person as an additional insured. And you might need to actually put the car in the person's name, and that might be in advance. But all these little issues come up, and this is why you need a lawyer. Just don't let the person drive the car. If they get in a car accident, who's responsible for that? The estate may be responsible for that, right? The trust may be responsible for that. So you really need to consult with an expert. Please keep good books and records, okay? Expenses have to stay reasonable. Everything sees the light of day. I will tell you, in whether it's a trust administration or whatever it is, when somebody passes away, all this stuff comes out to the surface. Everyone's going to find out, but you have to keep the expenses reasonable. A $200,000 memorial service for a normal person is not, that doesn't make sense. Now, $200,000 for a very famous person or some, whatever, that might be reasonable. But reasonable is what the reasonable man, the reasonable person says, yeah, that's, that doesn't seem too out of whack considering the circumstances. So when hiring yourself and your family members, it's really important to pay close attention to that, because if this thing ends up in court, it's going to get extra scrutiny from a judge, and a judge is the one who ultimately decides whether these are reasonable expenses or not. Optional expenses, I would reconsider those things that you don't have to pay. It's not your money, it's the beneficiary's money. So I know I'm kind of repeating myself that it's not your money, but this is really important to understand. This is other people's money. The trustees personally have to pay inappropriate expenses. Well, that's the remedy, right? So if the trustee spends $10,000 on something that's not of a benefit or necessary for the administration of the trustee will be surcharged. That's the term, surcharge. The trustee will be surcharged and have to put that $10,000 back into the trust, okay? Trustees are 100% personally liable for everything. Trustee compensation. Can a trustee be paid? A trustee is entitled to reasonable compensation, usually. A bad trustee, if you do a bad job and you've taken compensation, you may be required to disgorge all compensation. That is a remedy for a trustee who does a less than acceptable job. Some counties in California permit 1% of the trust corpus per year to be paid. Others don't. Most courts do require detailed or hourly billing. And you have to do a good job. If you don't do a good job, you're not getting paid. There's fiduciary law. All right, you're held to a fiduciary standard. It's very important. Double dipping. What do I mean by that? If you're the child and you're named the successor trustee and you're a realtor, you can't take a trustee fee and a real estate commission, right? For being the trustee to sell the real estate and to be the realtor handling the real estate. You can't double dip. So that's something important. You need to talk to a lawyer. If you are a realtor, you may want to send that to a friend, or you may just subtract out the time that you spent dealing with the real estate, but there's a way to do it, but you just need to talk with a lawyer. So managing your assets, we put on here a written financial plan is required. Now, it's not required legally, technically, but it's a really good idea, because if you have a written financial plan, remember I said that the trustee is 100% personally liable. If you have a financial plan, you are not liable for the assets going down in value. If you do not have a financial plan, you very well may be liable for the assets going down in value. So we had a lot of market volatility this year in March, and I can tell you, we would sometimes get pushback from people. They go, come on, this thing's only going to take a year, and I don't think I need to do a written financial plan. It just sounds like a pain in the neck. Well, no, the people who did it when the stock market went down, they were so happy, and the people who didn't were really scared. Now the market came back up, the stock market, but it's something to really consider. Diversification, you do not have a statutory duty to diversify. But again, if you have an overconcentration, it might make sense to diversify. Some people go so far as to liquidate the assets and just have cash for a period of time. That is one approach. And then you've got certainly Prop 13, 58, and 19 considerations. I strongly advise when you're selling real estate to consider listing it on the multiple listing service. Properties that are listed on the multiple listing service, I believe that the figure is about 13% higher on average sales price. So very important that you do that. And, in terms of paying a real estate commission, does a trustee have a duty to chisel down or, go to a discount broker? No. 5% seems to be sort of the standard in California. It used to be 6, but now it's down at 5. And I don't think you're going to get in trouble as a trustee hiring a broker on a 5% commission. Don't take too long to sell the house. So one of the common calls we get from people is they say, well, mom and dad died 10 years ago. And my brother moved into the house and he's the trustee and I haven't talked to him in 6 years. And he just kind of stopped taking my calls and he's just living in mom and dad's house. That's pretty common, right? We hear where people just kind of move into mom and dad's house and like, it's kind of nice here. I'm the trustee. I think I'll stay here. But you have to follow the terms of the trust. Most trusts aren't written that way where the brother can just stay there indefinitely. Asset sales can trigger taxes, very important, especially a B trust. Remember we said when people die, you get an adjusted cost basis. You do not get that on a B trust, right? And so if you sell property out of a B trust or you make a distribution, sometimes those are tax events. And then taking too long can trigger taxes and penalties. So the example where the brother maybe was in there in the house for a long time. If he didn't file his claim for reassessment exclusion between parent and child, and mom's name is still on the property tax bill 10 years after her death, that property, there was a change in ownership when mom died, and they have to file their claim for reassessment exclusion, and they really need to get on it. And unfortunately, they end up with back taxes. So it's either reassessed or it's not, right? And if you wait too long, sometimes you can't file your claim for reassessment exclusion. And then you end up with a big extra tax bill. So distribution, so there's a 120-day period between the time that somebody sends out a notice and when the period to challenge the trust ends. What I mean by that is a person passes away, mom and dad pass away, and the trustee sends out a letter that says, here's a copy of mom's trust, you have 120 days to challenge that trust. And if you don't bring an action within 120 days, you can't challenge the trust. So what we typically do is we typically wait to make distributions until that 120-day period is up. You need to be mindful that there's a 1-year rule for cash gifts. A cash gift, I give $10,000 to each of my grandchildren. Those gifts have to be made within a year. Otherwise, they bear interest at the legal rate, which the last time I checked was a lot more than you're going to get on a CD. So that is, very well could be a breach of fiduciary duty for the trustee not to pay those within a year. So if the trustee waits into year 2, the trustee may be personally liable for paying the interest on those gifts. Typically a residual distribution, this is, after the payment of the debts and expenses, I divide up all my property between my 3 children. That happens at the end. And we do counsel trustees to reserve funds for potential liabilities, income tax liabilities, tax audits. And this is something really important. Absent a refunding agreement, which is a return agreement of a distribution, a trustee is actually legally prohibited from seeking reimbursement from beneficiaries. So you can't seek reimbursement from the beneficiary unless they've agreed in advance to give it back to you. Please hire competent tax advisors, okay? A trustee is 100% liable for actions, inactions, and misdeeds. And, sometimes people don't file their taxes, and sometimes they're back taxes. A trustee needs to hire a competent tax advisor because it's the trustee's job to get all of these returns filed, right? You got a 1040 and 1120, which is a corporate return, 1065, which is a partnership return, and then the California income tax return, which is a 540. You got to file those also for the trust if there's more than $600 in income. And estate tax returns, not only for large estates. So even if someone has a $2, $3, $4 million estate and one spouse dies, we're typically filing what's called a portability return. That's because the deceased spouse has $11.58 million in 2020, $11.58 million that they can leave to a surviving spouse, but you have to file a tax return so that surviving spouse can claim the $11.58 million. Well, what if Joe Biden drops the exemption down to $3.5 million? If you don't do the portability return, now the survivor only has a $3.5 million exemption. But what if your estate's $5 million when you die, right? It's about a $600,000 tax bill. If you would have filed your portability return when dad died, right? Mom would have inherited his $11.58 million exemption. Now she would have her $11.58 million plus a 3.5. That's a lot, right? It's $15 million. And so the family saves the $600,000 in tax. So it's very important to pay attention, even on smaller estates, because we don't know what the tax laws are going to be in the future. Please consider portability. There is a time deadline on that as well. Work with an expert attorney. A trustee needs expert trust and estate attorneys. Don't go to a novice. A lot of attorneys who do estate planning, a lot of them actually don't do trust administration. It's just a different thing. It's related, but a lot of them don't do it, or frankly, they're not quite sure what to do because they just don't have a level of experience on it. So I would consult an expert attorney from the get-go. You need to give all the information to the lawyer. And this is really important. Don't hide the ball. Don't say, well, I'll give you this, but I'll give this other stuff to you later. No, it doesn't work that way. The lawyer has to see everything. It's like going to the doctor saying, okay, you can look at my right leg, but not my left leg. I want to talk to you first. No, it doesn't work that way. It's all confidential, okay? Except it's confidential, but it goes by the office of trustee, meaning if you're a trustee and you come to the lawyer and anything you say with your attorney while you're trustee is confidential. But if you stop being trustee, that office, that position goes to another person, the privilege goes to that other person. So that person can have full access to the conversations and correspondence of the prior trustee with the attorney, okay? So what if a trustee says, I kind of want to keep some of this stuff secret, right? I think I might have spent some money that I probably shouldn't have. A trustee can hire with their own money, not trust money. They can hire their own attorney for their own counsel, and that is confidential, okay? So, and that doesn't go to the next attorney when they step in. So a trustee, again, you have to remain engaged or step down. Don't drop the ball. You got to communicate with beneficiaries. You got to communicate with the tax preparer. You got to communicate with the attorney. You got to talk, email, text, whatever. We have a YouTube video on here that covers, do your adult children know what to do when you die? All right, go to our YouTube page, follow it. You'll be on our feed for videos as they're posted. So what are the action items when someone passes away? So if you're watching this and this is maybe the first Thanksgiving that, you haven't, maybe the first Thanksgiving where your parents are not here with us anymore, right? They passed away in the last year. Don't wait a year, okay? When they say, because you'll talk to the little old lady and she'll say, well, my friends, they said, don't do anything for a year. Yeah. Don't sell your house. Don't get married. Don't, I don't know, but go see your lawyer, right? Go to your accountant. There's a lot of stuff you need to do. Don't just sit and wait a year. All right. Seek advice before serving as trustee. Very important. Seek out an expert. You need to know what you're getting into. And you know what? Be kind, be generous, take the high road. Don't be petty, keep good records, maintain professionalism, right? And sometimes that's really hard when you've got a jerk brother who's screaming on the phone. Just take a breath before you engage, because this is a really stressful time for people. Loss of a parent, it's a big deal for everyone. And remember, anger, the flip side of anger is fear. So a lot of times when people are angry, what they really are is they're afraid, or they've suffered loss, or they're sad. And so, have a big heart. Seek out expert advice from the attorney. It's the order of advisors. The attorney first, okay? Then the CPA, financial advisor, realtor, but you really need to check in with the lawyer first. And you can go to Cunningham Legal to book an appointment. That brings us to the end of, we went a lot longer than I thought we would. I'm going to answer some questions. If you guys have any last call for questions, let's see. We have John posts a question. It's very legal technical. Jessica asks, surviving spouse has one child with a home worth $8 million, purchased for $200,000. One rental worth $1.5 million, purchased for $200,000. Another rental worth $1 million, purchased for $350,000. Is this a simple or complex example to preserve Prop 13? What's the best option? That one, you're going to really have basis issues, Jessica. But I think we would use the structure. And when I say Prop 13 trust, it describes grantor, non-grantor trust. It describes a lot of different kinds of trusts. But I would think on that one, you'd want to, if you're asking for a client, you would want to look at their situation. Do they want to keep these properties when somebody passes away? Because if you don't want to keep the property, there's no you don't have to worry about Prop 58. And then also now you're getting into estate tax territory because that's $10 million in real estate. So pretty complex stuff. Well, that brings us to the end. If there's any more, if anyone wants to put a Q&A in there, any questions, I'm here to give answers. If not, have a great Thanksgiving weekend. And I want to thank everyone for the people who stuck around, for sticking around. And please share this video with your friends. And this will be posted in just a few moments, tomorrow on Saturday. But have a great day.